Inside America's Boardrooms, the informational show for board members and corporate secretaries. Brought to you with Knowledge Partners, NASDAQ, the Center for Audit Quality, and PwC. Along with content contributors Equilar, Meridian Compensation Partners, Wilson Sonsini Goodrich and Rosati, Donnelly Financial Solutions, and the Society for Corporate Governance.
Welcome to this edition of Inside America's Boardrooms. I'm T.K. Kerstetter, the CEO of Boardroom Resources, and it's my pleasure to welcome you to the show. Today we're going to be talking about the key risks facing compensation committees. And I have actually as my guest somebody that serves as a chair of a compensation committee. And join me in welcoming Frances Skinner, who's the comp chair with Diamond Hill Investment Group. Welcome.
Thank you for asking me.
And just so everybody knows, the background here is just a little bit different. We're at the NASDAQ Entrepreneurial Center, which is a facility that helps new entrepreneurs get educated so that they can be successful in their startups or in their ventures or what they want to do. It's a great facility, and we want to thank them for having us as a guest. So back to the question at hand about risk. But first, let me ask you, as the compensation chair, how has that role changed over the last 5 years? Because we certainly have seen a lot of things happen.
Yes. So over the last 5 years, I would say the role has become much more comprehensive. So initially, pretty narrow in focus in terms of compensation and rewards. And just in my tenure, I've been on the comp committee 6 years, chair for 5. And I would say what we're looking at is so much broader. So it goes beyond, the standard, let's align interests between management and shareholders. And it is now aligning employees, board members, shareholders, and management all together. And it's a lot of moving parts trying to manage all of that together. So that's the beginning. That's what it always was. Now it's gone a lot broader in terms of getting behind motivations and talent development. Are we rewarding and positioning the next generation to be ready to come along and be viable candidates to take over? In terms of, are we incenting people to remain hungry, that they're not getting complacent, that they're constantly learning and developing? And the other really big change, and this has been really large over the last 3 years, I'd say, is that risk is now an integrated topic throughout the compensation discussion. That, when risk first gained prevalence, it was over here, maybe an audit or people, forming separate committees. I know when we talk about comp, we are integrating the risk conversation throughout all of those discussions. What risks do we have out there in terms of bad results, good results, and what that could expose us to, and how do we, manage that, et cetera. So this whole concept of integrating the risk conversation throughout all compensation discussions, that's definitely something that's new.
So how about say on pay? That had to have changed comp committees significantly in the kinds of discussions that you have now.
Well, for us, and you hear this from a lot of my peers, it's more about awareness about perceptions, and being in front of things in terms of explaining things well on the front end, the story and the why, rather than just do something and sort of cross your fingers. So that's the difference that Say on Pay has brought, is that you may have that discussion. You absolutely do have those discussions in the boardroom, but you go the extra mile. And when you're creating your CDNA and you're talking to people, you're absolutely painting the picture for them, that they understand why you've done things, what the context was. It's not just about, here's a chart.
So when we talk about Say on Pay, there's some interesting things that have happened with Say on Pay. It's not something that happened at your place or whatever, but because this has been developed as a vehicle for shareholders, it's interesting that we have seen some companies that have done the right thing. The comp committee has done the right thing with their Say on Pay. A company has a poor performance, the pay goes down. But the shareholders who are upset about the stock price going down still vote against the pay package, even though the compensation committee structured it correctly to go down when that happens. That has to be a little frustrating for a comp committee, and B, I'm sure that wasn't the intention when they put in a non-binding vote like this, because now the comp committee could, have a vote against the next year, even though they did everything that's right. It's got to be a little frustrating for a committee member.
I'd say absolutely for those companies that it happens to, that you've put all this work into it and everything worked exactly as you expected. And the big thing about that is definitely about engagement, that you explain things to people, you're in front of them before those things happen to try and head that off, that you want to get and hear them before they feel their only mechanism is to put a negative vote on, say, on pay just because they haven't been heard.
Yeah. But it is their only, it is the big vehicle, that you can do that without voting against, directors, which we don't want to have happen either, unless they absolutely have been in a position to deserve it. But,
Right.
So the reason you're here, the big reason, we want to ask you about risks. What are the risks of a compensation committee when it tries to balance both the CEO's and the shareholders' interests? And I'd be curious to what you think those risks are.
So I've been working with compensation in the financial services world for over 20 years. And I would say number one risk is that delicate tipping point between incenting the right behaviors, rewarding people so that you can retain the great talent, and representing the best interests of the company at the same time. So it's a really narrow place at the top of the fence where you're doing both. So I've always considered that to be the biggest risk, that somehow you overcompensate one way or the other.
And that seems like that's also the goal. The goal is to be at that spot,
Yes.
okay? And it is a very narrow spot, and it makes a lot of sense that it's the goal, but it's also the risk of falling too far one way or the other.
Right, and I would say then the second one is, just because we're human, sort of knee-jerk reacting to the present and the current, and it's so important that we never lose sight of the long term. So things like, as we have conversations about retaining capital, investing in the business versus distributing things and rewarding people appropriately, that we never lose sight of that, despite the fact that there's, you're constantly bombarded on a daily basis with things that could potentially have you thinking more short term. So I would say that's definitely a second big risk when you're thinking about, where you can fall down on this.
Okay, so that's a good one too. That's one that should be on everybody's mind. Okay, so what would be your third one?
My third one is, I think, a fear of being creative or innovative. That people want to sort of play it safe and do what other people are doing, rather than be taking a big step back and think, if we were just starting from scratch, what would this be? And what do we think is absolutely the right thing to do? And it might be something that, now you start having conversations about, well, when it is run through models and people are analyzing what we're doing, it's not going to work because it's too different, it's too creative. And that's unfortunate, because that is a big risk, that there could potentially be great solutions out there, but people are, kind of paralyzed about trying to take those chances.
Well, you and I are here at the Equilar's Compensation Committee Forum, and maybe the good news that we heard relative to that was that a couple of the investors talked about that discretion isn't necessarily bad, okay? If you can explain how it's important. I've always felt that there's a lot of things where the numbers aren't going to be near as important as the discretion. By discretion, I mean looking at somebody's ability to build a culture or build a good talent group, things that you can't necessarily measure, but we both know are very critical to the company's success. So to me, that was a little good news. Did you feel the same way?
I was very surprised to hear that, because normally what you hear is discretion is bad, it's a horrible thing. And as you said, some major institutional investors throughout today talking about that they understand it doesn't always have to be about the numbers, that there are these other things, developing the next generation, driving an ethical culture, a strong culture, et cetera. So again, I think that emphasizes the whole part about investor engagement. communicating that these things are important and that you will be rewarding them when you get them.
Well, Frances, I can't thank you enough. It's always great to have somebody in the trenches, okay, coming onto the show and contributing, and I'm sure our audience will like what you had to say. So thanks for taking the time to join us.
Thank you very much.
And that will conclude this edition of Inside America's Boardrooms. We hope you enjoyed the show. We'll be back again next week when we take a look at another critical topic that'll help you be a better board member or committee member. So we'll see you then.
Join us again next week for Inside America's Boardrooms. Brought to you with Knowledge Partners, NASDAQ, the Center for Audit Quality, and PwC. Along with content contributors Equilar, Meridian Compensation Partners, Wilson Sonsini Goodrich and Rosati, Donnelly Financial Solutions, and the Society for Corporate Governance.